It is great to be joined today by Dima Okrimchuk, who is the CEO of Platio, which is a very, very interesting new project that lets you send and receive payments in cryptocurrency or in traditional currencies by card or bank transfer. So first of all, Dima, thanks for joining me. To begin with, what's the problem you're looking to solve here? In other words, what's the opportunity or the lack of a solution that you've identified?
Yes, thank you, David, for hosting me. And it's a very good question to start off because the essentially it might sound like there is no problem, especially if we talk about the developed markets like Europe or the US, where the financial system is indeed developed and allows you to do 99% of what you actually might need. But if we talk about the rest of the planet, there is a specific number of people who actually don't have any access to banking system. That's about 3 billion of people who are totally unbanked. So, in my opinion, crypto is actually allowing to bring these people into the economy of the world, and it's a very good tool for that. That's sort of the one problem that we're solving. The other problem is, crypto and specifically Platio will allow financial transactions to be happening more efficiently. It would take less time for the transactions to be happening. It would take less effort and less commissions for the users. So we want to democratize access to finance. Take the best from the traditional financial world and build it in the most technological way that's possible.
Can you talk a little bit about, I mean, when we think about the history of money and this sort of journey that we've seen from barter through currencies as we sort of know them, government-backed currencies, and then into crypto, there's often misconceptions about where and when and why we moved from barter to fungible currency and sort of that process. I mean, how does that play into where you see currency going bigger picture?
hmm So indeed, the money took place from barter. That was, the first transactions where people actually sort of had the first need of money because let's say 10,000 years ago, when people settled down and started to do farming, they had certain specializations. So some people were good in producing clothes, some in weapons, some grew wheat, and it became very difficult for people to exchange those goods because people who produced weapons, they needed to get some food as well. And this is when the first sort of version of money appeared. In the beginning, these were shells. They kicked off from Africa, and they served as a mean of exchange between those people. And actually, some of those shells were actually used in Uganda up until the beginning of the 20th century. And these were the money that were resilient, that were physical, so they were tangible. But the community didn't agree that the shells could serve as the only mean of transacting because there was unlimited amount of these shelves. So there was no trust at the end of the day. So that's the thing that was missing, trust. And then 600 years before Christ, the first coin appeared, and it had trust that was built in by the authorities or by the ruler that actually stamped those coins, and that was happening in ancient Greece. Um, so although there was trust on one hand, on the other hand, there was total control of the ruler, so he could say how many tokens were issued, and he could put his stamps on that, and that was the only way to actually produce those kind of money. So the supply of that was very limited. And in reality, it was very difficult to be using those money because the tokens, the coins were, they were heavy. and it was difficult to carry them around and essentially transact. And that led to the appearance of banknote, which was first founded in China. And essentially what banknote meant is that you had some amount of valuable goods stored in an institution, and this banknote actually proved that you were the owner of those valuable goods. Although it happened in China 100 years before Christ, it took a long time to push this effective tool to Europe. So Marco Polo in about 30th century brought banknotes to Europe. And then again, it took a long time for Europe to adapt banknotes. And when there was a mass adoption, banks actually started to issue banknotes. And what they did, they actually issued more banknotes than they had valuable goods stored at their end. And this was actually the first thing that kicked off the monetary system that we all know today, and it was the first signs of inflation.
And one of the things people
So,
may not
yep.
necessarily realize is that now, even though there's a big conversation now about crypto versus so-called normal currencies, and I think that it's a completely reasonable conversation to be having about the pros and cons. But one of the misunderstandings that I think some people have is they don't realize that in sort of Western economies and modern economies, even though we still have this supposed hard currency, an overwhelming majority of that money exists only digitally already, in the sense that it exists in computers, at bank accounts, in governments, et cetera. Now, that doesn't mean it's the same as crypto, but I think that this is something a lot of people don't necessarily realize about how a lot of the currencies we work with every day exist overwhelmingly in the digital space already.
You are exactly right, David. And so 90% of the currency, it actually is a digital currency. So only 10% of the 50 trillion US dollars that are in banknotes or coins, they are actually printed money. The rest is electronic money. That said, those electronic money, they're issued by governments, they're controlled by governments. They are different all over geographies, so there's no single currency that's being accepted by every country in the world. Although a lot of endeavors were put in by European Union, but it didn't. For some of the countries, it didn't end that well, and I'm sure you're aware that some of the countries are trying to push away from having euro as their main currency, although they're still being part of the European Union. So in this evolution, crypto is still indeed an electronic form of money, but it has these extra features which brings a lot of benefits to the society. So first of all, cryptocurrencies, they are decentralized. So there is no single authority that is able to dictate the rules or features of the money that are being issued. Then cryptocurrencies essentially are trustless. So all the transactions are being written down on the blockchain. So it's very easily to track all the historical transactions. You don't have to hire an audit firm to make sure that these transactions within the specific company were happening, because this is already public within the first second of that transaction taking place. And the last but very important feature of crypto is that crypto is actually peer to peer. You don't have to have a bank in between, which charges you extra commission for servicing the payments. So you can actually send the money directly to a person that you want to be receiving the payments. So I think these are three main things that distinguish electronic money from cryptocurrencies.
So those are certainly, I would agree, some of the features at this point. I'd love to talk with you a little bit about what I see as some of the big possible liabilities right now of crypto. And maybe we can talk about number one, whether you agree that these are the liabilities, and number two, whether these are going to be solved. The two that I see primarily right now are number one, volatility in terms of the value of some of these coins. And number two, that in sometimes in practice, sometimes in theory, because we haven't reached it yet, we are dealing with sort of transactional limits based on the processing power of how a lot of these cryptocurrencies are sort of organized. Can you talk about number one, do you agree that those are the two primary issues right now? And number two, will those be solved?
Hmm. I do agree that that these issues exist, and they are volatility. For example, it is indeed a barrier for some of the people to be using crypto as a mean of payment, for example. On the other hand, there are solutions to that already. So there are a bunch of stable coins which were created. Essentially, they're pegged to US dollars. I do think that this is an intermediary solution because at the end of the day, cryptocurrencies will gain as much trust as US dollar has these days. There are ways to actually, bring down the volatility, to control volatility by pegging it to the US dollar. So, but it is an obstacle, but there is already a solution for that. And in terms of the resources that you need in order to log the transactions onto blockchain, well, that's an issue related mainly to Bitcoin specifically. And the good part about cryptocurrencies, again, is that these cryptocurrencies are being constantly developed, and the technologies that they're based on, they're also being developed. So, in some foreseeable future, you wouldn't have to put so much electricity resources into making sure that transactions made on Bitcoin were valid. And maybe if that doesn't happen to Bitcoin specifically, there are going to be other cryptocurrencies which don't require as much resources to prove that transactions. So there's Bitcoin essentially is using a proof of work algorithm. Essentially, there's a more efficient algorithm called proof of stake, a totally different algorithm, but it doesn't require as much resources. So again, these are two very valid issues, but there are already solutions for that.
So let's talk a little bit briefly about what Platio is doing. I know you're currently in charge of a project called Platio. Let's talk about what it is that you are proposing and anything you want to sort of say about that.
Yes. So one of the problems that you mentioned, the volatility problem, we are totally aware that this is something that prevents some of the newbies to crypto to be using bitcoins or ether as a means of payment. So we actually created a solution that that prevents, or not prevents, but actually saves our users from those Bitcoin movements by allowing them to sell at a specific point in time when the crypto falls below a certain price. So that actually brings some additional comfort to our users when when they bought Bitcoins or Ether. The other thing that you haven't mentioned, but I think is important, when we conducted interviews with our users, we realized that one of the issues that stops them from buying bitcoins and using existing wallets is that they've heard that hundreds of millions of US dollars were lost when people lost access to their wallets, either by losing the seed phrases to those wallets or either by losing phones which had two-factor authentication to access the wallets. And these news kind of became the hurdle. And we came up with a very elegant solution. It's called Asset Guard. essentially what it allows you to do is you set a specific amount of time of your inactivity within the platform, and after that time, all of your assets are either transferred to a different crypto account or they're transferred to your bank account.
Hmm.
So I personally call it an inheritance in crypto, because I hate this example, but if a man dies and he was owning some bitcoins, that's actually the only way for his family to inherit the bitcoins or ether that he owned through Platio.
Absolutely fascinating, and a really important issue that a lot of people I've personally talked to are actually dealing with right now, and that is a major issue. We've been speaking with Dima Okrimchuk. You can learn much more about his work by using the links down below in the video description. Dima, thank you so much for talking to me today.
Thank you, David. Thank you. It was a pleasure.